Welcome to 10 Minutes About Oil Markets. Today we are in Copenhagen, Hellerup, joined by Arne Lohmann Rasmussen, Chief Analyst and Head of Research at Global Risk Management. Welcome to you, Arne.
Thank you.
Let's dive straight in. What is the current status in the oil market after the war between Iran and Israel?
It is like that we are back to start. It's a bit cynical to say that, but we had this 12 days of war. Risk premium was priced in, a lot of concern about the Strait of Hormuz. Would that be closed? What will happen to Iranian oil export? What will happen to the oil products going through the strait? What will happen to the whole situation in the Middle East, to shipping and so on? Then we had the kind of ceasefire a few days ago, and we are basically back to normal. Now we're back to focusing on some of the things that we also focused on before the war. What will OPEC do? What will the economy go? What will happen with the EU-US trade negotiations, and so on. It's a bit like it's never happened, but of course it has happened.
Is there any risk premium left in the oil market now?
No, that's I think that's just the clear answer here. We have a small model where we try to say, okay, if we look at what the dollar is doing, what you call risk appetite, equities, US inventories, and so on, and we try to model the price. And then during the war, I think there was a risk premium perhaps more than $10. It is completely priced out now. If anything, we might actually be undershooting slightly compared to what our model would indicate the fair value price would be. So I don't think there's any risk premium left.
No.
But of course, we don't know. It's not something we can directly trade or measure in the market.
What about the products like gas oil, diesel, and fuel oil?
Yeah, we saw
What-
during the war that they spiked, that the so-called crack, the difference between one barrel of diesel, gas oil, jet fuel, and so on, compared to a barrel of Brent oil, that spiked quite a lot. An extra $10 on top of the move in the oil price, that is more or less also priced out. It tends to be slightly higher, but that could also be for other reasons. So we are basically back to where we were before the war.
Oh, yeah. Assuming that we are back to normal now, what areas would you recommend that we look into for the upcoming months?
I think we OPEC Plus is very important. We have the next sort of OPEC Plus meeting July 6th, and there they will decide whether they will continue adding extra oil to the market in here it's in August. Remember, they have been doing these big production increases that have surprised the market. I think there will be a final big oil increase coming. So that's one thing to focus on, but it is an open question what they're going to do, because I guess OPEC Plus also assumed that there will be less Iranian oil coming to the market. Maybe that is not the case. We're talking about Iran, of course, the negotiations that apparently are going to restart now, the nuclear negotiations. Do we get a confirmation whether the nuclear facilities was in fact destroyed or not? The trade war, July 9th, we have the deadline for the EU US trade talks, and at least a deadline for sort of this postponement Trump did. The Fed, the US Central Bank, are they going to join the ECB in cutting rates? The dollar has weakened a lot recently. Will that continue? And finally, I will also keep an eye on Trump's big, beautiful budget bill. Will they be able to go through Congress or not? That could be a big fight the next couple of months. I think the calls for a sort of a US recession are off the table for now, but it's still quite uncertain how that will develop. So OPEC Plus, and then more geopolitics in respect of US politics, trade talks, and the talks with Iran. So could this situation flare up again? And as we discussed before, there is basically no risk premium there. So if it flares up again, it could impact oil prices again.
Speaking of Trump and the famous phrase, drill, baby, drill, will that send oil prices down to $50 per barrel, like he suggested?
I think the issue for Trump or whoever is calling for lower oil prices, every time we go down to like the mid 60s or lower, then it has an impact on US oil production. So you cannot have both higher oil production and lower prices. Today, when we are recording, we are trading just below $68. That's probably where it starts to impact U.S. Crude oil production. It's simply not worth it for new drills. We see the number of oil rigs are falling. It's difficult for them to invest. So I don't think we will see this drill baby drill expansion in U.S. crude oil production. And I think that's also what OPEC Plus is betting on. That's why they're coming more oil on the market, saying that as long as we don't push oil to like $100 or $80, $90, they will not be able to boost production significantly.
How do you see prices evolving over the next 6 months and next year, 2026? How should our clients hedge their exposure, according to you?
Actually, I think the outlook is a bit boring, which is good from a risk management perspective. I think there's a very, very strong support at like $65 for oil. That's because there you impact U.S. production, as we talked about. It probably impact the way OPEC Plus react. The weaker dollar, maybe this U.S. central bank starting to cut rates. We don't get a U.S. recession. It's actually positive. And then something people have seemed to have overlooked a bit, I think, is that we actually have a relatively tight market at the moment. We see, for example, U.S. inventories are at the lowest level for this time of the year in 10 years. So if anything, I see a small risk to the upside, maybe trading around the $70. How should you see this from a risk management perspective if you're a consumer of oil or oil products? I think the war we just went through underlines that if we're going to see a big move, it's rather to the upside than to the downside. There's also some backwardation in the curve, so the forward prices are a bit lower. So I actually think it makes sense to have a maybe above benchmark hedge ratio for the next 6 months. Looking into next year, I think it's a matter of using. If we see setbacks in oil price, of course, we'll see that from time to time. If we see, for example, a drop to 65 or below that, given that we also have this backwardation, lower prices next year in the forward market, I think that would be an excellent opportunity to lock in some exposure also for next year. So actually, maybe a hedge rate actually above what you normally would consider the normal hedge ratio in your company. But it is a lot of people out there are calling for significant lower oil prices. I don't think that will materialize. Also, what we've been discussing today.
Thank you very much for joining us in Copenhagen today, Arne. I look forward to our next conversation, where we will be diving even deeper in the gas market.